the AG trade that I have set up, and I originally thought that it would bounce off. And you were right; I should have sold at like the 791 mark, so I would have been able to take that profit. Like I said, I'm still practice mode. Really, it's one of my first trades on actual money. I'm still dibbling with back and forth between paper and trying to fund my account at the same time. I'm trying to get out of working 7 days a week and try to do that type of stuff. So
Well, I appreciate you sharing that. I think so you're just making the transition, you're saying, from paper to live capital. And when you got in this trade, did you have a trade plan ahead of time, like on where you were looking to get out?
I only have 2 contracts in it, so it's not very much.
Okay.
It's $60 in total. At 791, it was at, like I said, it was right around 59 cents per contract. I think it went up a little bit more than that, but at the same time, my trade plan was to go past the high because it did have a lot of momentum and a lot of volume behind the contracts.
Okay.
But it was hard resistance at the 791.
I see.
So I thought at the fair value gap, it would go back for the retest on that one.
So you were looking at the 791 area. We had 2 tests. You thought we were going to break this, and that would open up some more room to move up to that high at maybe like 844.
Because I thought it was going to retest to that high is where I originally thought. So that was my plan to get out right around there.
A significant amount of this move. So you got in when the order came through on the software, correct?
I think I got in probably about a half hour after the fact.
So you got in down here at $5, right?
Probably somewhere around there, yeah.
So
I didn't take a screenshot, which that's what I'm also trying to get better at, is trying to track everything I do.
I would, if you haven't yet, set yourself up on a trade journal. As I'm rebuilding the master class, I'm going to show you guys how I journal my trades. So I would get set up on either TradeZella, EdgeWonk, or honestly just use like an Excel spreadsheet. And then have your entry, like when you enter, screenshot the chart of your entry, same thing for your exit. But I'm looking now and you're up still, if we're looking at AG, the stock and its share price, 32% off of where you entered.
Yeah, at one point, I think the contracts were up about 100 and $120, but I was still trying to hold to the plan that I had.
So those contracts were up about 120.
Yeah.
You got them at 30. So that's phenomenal. But you really wanted that extra. So at this point, the stock was up. AG was up 55% since your entry, and you were looking to get another 6%. I think I want to address this because this is how I would have looked at this situation. Let's rewind. We're not down here. We're currently trading right here. Pretend this is like where we're actually trading. Now, if you look at where you entered, we just chart down from where we're currently trading. The stock is up, let's say 50%, right? We could just round. And we're still sitting off of all-time highs, about 8%. So if you look at the margin, you've made about 50% on the chart, right? Those contracts are up now 300%. You've got about 8% still to go. By staying in the trade at this point, what is your risk and what is your reward? Well, now until you've secured the profit, your risk is still that whole move, that whole entire position.
Right.
You're up 50%. On the table, you've only got about 8% worth of reward. So you're still at risk 50% and your reward is only 8. And if you look at it from that perspective, like what is 50 divided by 8? It's 6.25. So like your risk reward is totally flipped. You are risking now way more than you even have the potential to make. You just made 50%. You're worried about making 8% now instead of securing that 50%. So that 50% is still at risk until you sell. And you can see obviously now that we've come down, you've given back 20% because you wanted to make an extra 8. So when you look at how much you're up on a trade, regardless of your TA, of your strategy, this is hard for me to explain, but regardless of the way you're trading, when you look at that chart, you look at how much you're already up and how much you have left to make and ask yourself, okay, if I'm up 300% on these contracts, and even if we continue pushing and whatever the gap is broken and we push up to 844, I'll make another 25%. So I'm staying in this trade with my entire 300% I'm up, still at risk to only make another 20%. So next time you're in a situation where you're up that much, I would just look at how much you've made and then how much you have left to make and really decide if it's worth staying in that trade. What kept you in that trade for so long? I get your logic and reasoning behind that, like trying to stay in a little longer, but what kept you in for that entire 50% move? What were you looking to see?
For the initial, or for the plan itself, was to get out at the high, because there was a lot of volume behind that contract, and the move was still going in my favor. So that's what kept me in it. So now, because that big green candle, so basically your big green candle off to the side where it went up to the 791 is the fair value gap. Beside that, which is the red one down below, that's your order block.
Okay.
That would be your basically your liquidity pool where everybody's basically trying to buy back in.
Yep.
And hopefully it will rebound off that order block and then go back to retest the 791. And now I know that 791 is a hard resistance. So if it doesn't pass the 791, then I'm done.
So you're looking at like 633. You're hoping we kind of bounce off this area and move back up to 793.
Yeah. So if it doesn't get past the 790 again, which I know is a very hard resistance, I'm done.
Smart. I mean, you've definitely done your research, even though that's not how I trade, like from a technical perspective. That's not how I'm going to approach a chart. I see what you're saying here. What if we lose 633?
If we lose 633, then at this point, I've already accounted for the money to be basically gone. I'm willing to risk the whole 30, per contract.
Okay.
So it's basically kind of like how you do. It's where, you're risking your entire thing.
You're still up how much on the contracts?
I think as of this morning, they're at 44 cents.
So you're up percentage-wise, like 30%?
That sounds about right, about 30%.
Now you have to look at this trade. Your risk is the whole 30 plus the whole position. If you get back up to that 791 area, how much are those contracts going to be up? What's that percentage? And then actually reassess your risk to reward. Because right now, I feel like you don't know where you're at, right? You don't know if you're at risk way more than you have the potential to make or vice versa. You got to reassess your trade and where you're at right now, because maybe you'll see that even if the contracts move back up to where you want, it's not worth risking what you're still at. You'd be better off taking profit. You see what I mean? Because this is almost like starting over and having a new trade plan, because risk to reward is never stagnant. The risk to reward when you get in a trade is always going to be changing. And this is a good example. I mean, you've been in this trade for the last 3 months, 2.5 months. And so as that trade continues to change, like the market changes and the trade is going to move like one way or the other, you got to reassess your risk to reward. It might not be worth it to even, stay in this trade. Maybe that 30% you're up, maybe you find this is what I should actually take for profit and just get out of this trade.
The smartest thing would have been to, like you said, sell at 791. I noticed the fair value gap at the 656, I think it was. And then, so if I would have sold at 791, waited until it got back down to the 6 something where the fair value gap was, and then rebought, would have been a smarter idea to do.
Based off of this concept you're talking about, you're saying this would have been the buy and this would have been the sell?
Yeah.
But you bought here. What someone would have looked to make getting in here and getting out here is already what you made getting in here and getting out where people would have gone in. I'm saying you should have been approaching this from the perspective, and this is why I don't believe in the concept you're talking about. You did exactly what everyone would do, and you should have done the opposite. So you got in, you should have got out when people got in. You see what I'm saying? Right. I would have used this as like, everyone's going to pick up on this, whatever fair value gap. They're all going to get in here, and then I would have gotten out, So I think when you look at a chart and there's a lot of people looking at the same chart, looking to play the same levels, some concepts hold true. I can't speak to too much of I know a bit about what you're talking about, but throughout the years, I've remained very focused on how I approach charts and my trading. It's very like specific, and I think you're looking at a couple different concepts that might even contradict one another. You were talking about trading the fair value gap, and then you were talking about another concept. I think you're just trying to use too many different strategies all hand in hand, and it's just not working.
Yeah.
You're looking at too much information, trading too many different concepts and ideas, and it's not working, right? So I would have, if we got in here, let's say theoretically we got in like right around when this order came through. The following day, what I'm normally looking for when trading are abnormal price movement, like price movement outside of not just the ADR, but I'm going to look at the ADR and then specifically on a daily, looking over a year, the probability to exceed the ADR. And that's how I would have priced in this abnormal move and gotten out here. It's funny because it would have been very close to the entry. When most of the people would have been getting in, I would have been getting out. So if you're looking at trading this concept and you're saying, hey, this based off of XYZ, this is where most people would be getting in, and then this would have been the trade here, and then they would have gotten out. If this is where I got in, this is where you got in, this is where the software buyer got in, just based off the algo I have, this is where I would have gone long, and then I would have gotten out here, which is like sitting, 3% off of where most people would have gone in. So I think kind of moral of the story, when you're looking at very common concepts like what we're talking about, everyone sees the same thing, and it's typically you're typically going to be better off trading against doing the opposite. You want to be in the small percentage of people, right, that are profitable, and most people aren't. Everyone's going to be trading the same concept, looking at the same MAs, looking at the same same support resistance areas. What we want to look at instead, we want to look at historical data. We want to look at, so this is why I say I'm looking back over the last year on a daily time frame. So I'm taking a year of data into consideration. And I do that because a year is still the most relevant, where if you go back a couple of years, the market really can shift. Like movement on one ticker could be extremely different one year versus another. I think looking back at the last 256 trading days is going to give us the most accurate data to work with. And then what I'm going to do is I'm going to take all of that data, all that information, right? And I don't even need to look at the chart. So pretend the chart's not here. And I'm going to see, hey, based off of the last 256 trading days, this is how specifically this stock, ticker symbol AG, moves. This is what the average movement looks like, which is the ADR, the average daily range, from the daily high to the daily low. How much area are we covering? And then you can start to actually price in moves. And not just that, but you can actually price in the probability. And you could say, hey, if AG is up 3% on the day and the ADR is 3.15, what is the probability today that we're going to exceed that average daily range? And then you can start to really project what's actually going to happen. And this is the script that I built into Thinkorswim, this algo. And this is essentially what it's doing. It's been able to say, hey, this is where we would have gone in. This is our long. And funny enough, regardless of this concept, yes, this is where most of people trading a fair value gap would have gotten in and gotten out, correct? Well, we got in before everyone even saw the trade. We capitalized on the move. We made our, what would have been 20% on the chart, which is significant. That would have probably been, think about this, with options, the faster that move can happen, the faster you can get that move, the better. The theta over time, you've seen your contracts have slowly, as the intrinsic value or extrinsic has shifted, they're not worth as much. We would have gotten this move the next day. This, if you look at this, how significant this software order was, this long came in, this software trade came in, the following day we were up 12%, and the day after that we gapped up another 5%. 20% within 48 hours, these contracts were probably up a couple 100%. We would have gotten out. That would have been our exit there. And then we would have secured that a couple 100% profit. We got that crazy move instantly. So I think, you got to look at, and this is really going to help. I think, there's a lot of concepts, a lot of ways to trade, a lot of ways to approach a chart. If you're trying to trade one concept, by all means, I'm not here to say that doesn't work or don't try that. I'm just showing you what I would do and how I'd look at a chart. And it's just interesting to see the way I'd interpret the chart and the way I would trade it, using historicals and actually projecting probability to exceed the ADR and kind of scaling that along the way, and really trying to maximize that profit. Because often with options, maximizing the trade and the profit doesn't necessarily mean holding for months to capitalize on that huge move. It might mean getting out immediately after a big spike has happened just because of the way options are priced.
Right.
So this could have been 200%
Yeah.
overnight. And then now that you've held 3 months, you might only be up 150%. Yes, you've caught twice the move on the chart, but the contracts, they're worth less now up here than they were here because of how long that move took to happen. So I'm looking in the order flow, I'm looking for the unusual orders coming in, and then I'm looking on the chart for that abnormal activity. And that abnormal activity is priced in through looking at historical data, right? And that's kind of the way that I would approach this.
Okay, I see what you see. So basically, I restarted my trade when that fair value gap came up, and then hoping or looking at the chart, saying a different plan, basically. So in my mind, I think I actually changed the plan instead of actually going for the plan itself.
Exactly. Yes.
So
I hope that helps.
I need to keep that and remember that then.
Yeah, write
So
that down.
yeah, because like I said, I'm a mechanic at heart, so that's what I do for my job. So I'm always constantly thinking about stuff. So, and I'm a very big self-reflection type of person. I can know when I'm doing something wrong and why. It's just, I think I'm a little bit more stubborn to kind of say, okay, I should just stop at this point, and then, you know what I mean?
Yeah, definitely some self-reflection, but now you at least know the issue, whereas before you didn't.
Right. Well, thank you, sir.
Yeah, no problem. All right, see you in the group, okay?
Yep.
All right, sweet. Keep it up.